Right, wonderful, Tim. Thanks very much. To the 50 or so attendees that we already have, good evening. At least from a South African perspective, it's 1802 South African Standard Time. We've got some guests from all over the world joining us tonight, and a warm welcome, actually a chilly welcome from Johannesburg, but hopefully warm and cozy wherever it is that you are as we experience the season change. Welcome to our first episode out of 3 for a Fireside Chat series, where we take a view as Simple Capital, in conjunction with some of our portfolio companies and friends of the firm, on the effect of technology on our day-to-day lives, and how some of the things that for hundreds of years have remained more or less the same or had incremental change now suddenly are starting to experience fundamental or exponential shifts. This is the first of a 3 series of episodes, and I've got some special guests with me tonight. But to start off, we thought that we would quickly play this video as a call to order while the last few people quickly do their logins and settle down for what we hope to be a quite exciting chat this evening. So enjoy as I give you this. There we go. And if you've just joined and settled in, good evening and welcome. My name is Willem van der Post. I'm one of the co-founders of Simple Capital, and I play the role of chairman for the firm. And before we get into tonight's conversation with our esteemed guests, I thought, let me just quickly run through some housekeeping. We'll cut this webinar off within the hour. So we're going to take 60 minutes of your time, depending on how our Q&A session goes. We'll start off with a brief introduction of who our guests are, then dip into the very essence of how technology is changing access to everyday goods in the era that we're in. We'll open for some questions from you, the audience, subsequent to that. And then we'd encourage you also to sign up and join our community. We do have some links on screen. And perhaps while you're settling in, time to open up the camera on your smart device and hover it over that QR code that we've got at the bottom right there, which will allow you into our Slido Q&A live platform. And that will enable you to pose some questions at some of our guests. It would help me if you asked the question specifically to someone, if it was addressed to someone. Otherwise, we'll throw it open to the floor as they come up. And I'll try my best to curate between running this episode, looking at these Q&As, and as well keeping to time, because we know that time is precious. And so that's the order for proceedings for this evening. If you're new to the Simple Capital community, welcome. We have what we call an MTP, a massively transformative purpose to which we align and aim all of our endeavor at achieving. And specifically, we thought we would put it up in a visual format to make it easy to relate to. Our MTP is that we democratize early stage technology investments into exponential organizations. And a part of our value proposition is that not only do we bring you as individuals that deal flow, but we also basket it in investment vehicles such as to mitigate for the risk, whilst at the same time shrinking ticket size. To date, we've had a single investment vehicle that we've raised with a portfolio of assets in it, some of whom you'll be introduced to tonight, and the others whom you'll be introduced to over the course of our series. And the first one that we'll have here tonight is in fact FlexClub from Tinashe, who I'm going to introduce you to in a second. Before we get there though, Simple Capital is a new organization that in itself has experienced exponential growth. We find that this value proposition of allowing every man in the street who wouldn't ordinarily have access to deal flow and investment opportunities in tumultuous but also exciting times like this has really struck a chord with users. And so in as much as our portfolios have grown, we've also found Simple Capital at a growth rate. And our team expansion has been nothing short of spectacular. On here, you'll see that we've put the names of our colleagues and our advisors. And what started off as an idea about 10 months ago is now a full-blown business. And so, yes, we're working very hard, but we're also having a lot of fun. So in Investco number 1, we've got 3 enterprises that we've invested into, FlexClub, Builder, and Noah. Today, you get to meet the CEO and founder of FlexClub. Next week, we'll have Builder, and the week thereafter, we'll have Noah. So be sure to sign up and tune into those episodes as we broadcast them. For tonight, though, let's get straight into it. I've got 3 guests here, and I'm going to ask them to introduce themselves. We're at Simple Capital focused on making investments simple, but our processes are also simple. So no complicated reading of CVs and bolstering. And I'll start from left to right and ask each member of the panel tonight to just do a quick minute of introduction in fireside style. Nice and casual, because we want to be able to be relatable to you, our audience tonight, and encourage you to ask questions from these individuals. You'll see exactly why we've created their presence tonight. So Theron, if I could ask you for an introduction of yourself, please, sir, and nice to see you again.
Yeah, thank you again for having me. I'm excited to be a part of this, coming from the United States as well, and from kind of that Silicon Valley, now on the East Coast, but spent the last decade over in the Valley there. So I've been an investor founder for many years. If I start to count up, it's probably about 15 years total. And most recently left my role as managing director with Silicon Valley Bank, where I was responsible for the West Coast, which surprisingly is over 60% of kind of the global ecosystem of early stage startups, to start a new company called Fifi. And our focus is on private market investments. So this is where we align really well. I feel very strongly about democratizing investing, making it open to everybody in the world and palatable, and everybody, just like you make public investments, is going to start making private investments. So adopting that in our product, where we focus primarily on deal flow management, the system of record, helping you keep track of your contracts, helping you be more sophisticated as an investor on your first investment instead of that professional VC in the future. And that's basically what we're doing here. And I'm really excited about this, and hope it's a helpful conversation.
It's wonderful, Theron. Thank you very much. Very nice to have you. And I think that the democratization is going to be a strong theme for this evening. So looking forward to hearing some of your thoughts on the future of democratization of investment. Then if I move on to Alon. Alon, welcome. Nice to see you again. I'll give you the same courtesy of a minute of introduction.
Thanks, Willem. Good to be here. Good to see everyone virtually. Quick introduction from my side. The most interesting part of my background, I joined Uber as their first employee in Africa back in 2013. It was quite a different company back then. I think I got a lot of skeptical looks from people when I told them I was joining Uber. Uber at that point in time were in 34 cities around the world. There were roughly, call it 250 employees at that point in time. To put that number in context, today Uber's in over 600 cities around the world, over 25,000 employees. So a very different company to the one that you see today. And as you can imagine, it was a fantastic journey. We had a lot of fun. We made some mistakes, but overall, hopefully we did more good than anything else. And I think that's part of the reason why I really love my time at Uber. We made an impact. And I think it's really special to be part of a company like Uber, like FlexClub, when you're building a solution, leveraging technology, but having a real world impact. And to give you some context of numbers, we had over 60,000 active drivers making use of our technology and millions of riders using the technology on a regular basis. Before that, spent a bit of time in banking, private equity, and I completed an MBA. So that's a brief intro from me, and we'll chat later.
Wonderful, Alon. Welcome. Very nice to have you. And I'm keen later on to explore with you some of the regulatory lags that ensue when technology companies like Uber make its way into an incumbent set of regulations. I think probably Theron is going to be able to comment a little bit on the same sort of disruption and the lag associated with regulation, how it catches up, and some of the pains that you go through as a company that has got huge promise, but perhaps might be hamstrung by some of the current regulation. Alon, just before I let you go, you like to paint by numbers. And I was wondering, this is totally left field, we didn't script this, but you spoke of the number of employees and the number of rides that you do. Is there an interesting stat around the miles that Uber has aggregated in total? Because I'm sure that must equate to something interplanetary.
Yeah, we used to measure it in terms of number of trips to and from the moon. I'd have to check, but it was a lot of trips. I'll check that.
All right, wonderful. We'll circle back to that one. And then the man of the hour, Tinashe. Tinashe, you need very little introduction to our first InvestCo community members who got to know you intimately, invested in your company. But for those that haven't met you yet, would you mind, for just a minute, tell us a little bit about who you are and how you came to where you are tonight?
Absolutely. Yeah, thanks a lot, Willem. I'm actually in South Africa at the moment, but I'm typically based in Amsterdam in the Netherlands. And the story of how I got there, so I grew up in Pretoria in South Africa. And the story how I got to Amsterdam was actually tied very closely to Uber. So I spent a decent amount of my career at Uber focusing on what's called vehicle solutions, designing products with banks, leasing companies, car rental companies, car manufacturers, dealers, etc., to increase access to cars for then our community of drivers, a community that Alon pointed to just a moment ago. Took the insights and the vantage point that I had, building that at Uber, to then design a marketplace and a product that is now FlexClub. So I'm now the CEO and one of the co-founders of FlexClub, having founded FlexClub just over 2 years ago. So we're still very much an early stage business. And like you said, very grateful for the investment support we've received from a number of the audience participants. And obviously looking forward to continue to share our story and hopefully get more allies along the way, whether that be in the form of investors, people joining our team, etc. So yeah, very excited to be here.
Welcome, Tinashe. I think you and Elon Musk prove that in order to achieve great things, you basically need to escape the vortex of Pretoria. So well done for doing that, and welcome here tonight. I wanted to immediately get into the thick of things and ask you about this slide here. And for those of you on small screens, this essentially is a tweet from Uber from a couple of days ago. In fact, it's fresh. And in there, it starts to intimate perhaps some business model changes that look at the rental. So what's happening here, Tinashe? Is Uber going rental? What's going on?
Yeah, look, this is a very interesting one. And, obviously based on my introduction, a lot of the work I did intersected with, this type of stuff, particularly engaging with car rental businesses. I think at the core of all of this, Uber has been on a pretty strong path to improve customer experiences, reduce friction. So if you think about the number of mobility experiences that could do with some improvement, car rental is definitely not exempt. I think very few people will talk about how they love standing at a check-in counter at a car rental branch waiting to pick up a car. And this, I think, is an interesting evolution from Uber's perspective. Uber had built a reputation creating seamless, frictionless experiences. So great to see them move into the space. This is a very different use case to what our business is focused on. So this is definitely focused on the weekend getaway, a short-term use case, but it certainly validates that there's a massive opportunity for technology players to improve archaic customer experiences, with obviously car rental being one of them, and that's the introduction of Uber Rent.
I totally relate to that. In fact, I'm traveling tomorrow, and I know what's going to happen when I arrive at the counter. Firstly, with ill-conceived COVID protocols, I'll be confronted. And then second to that, there's the inevitable, did you know that you need to put 30,000 Rand onto your credit card as a holding deposit for the next month? So certainly I can agree with a lot of the friction points that you're referring to. But why is this significant? Are we talking about the tip of the iceberg here of a bigger trend, or what do you read here?
Yeah, I guess I have, a somewhat outdated view of what the direction was. And obviously that continues now with Uber in building out a mobility as a service platform. So there's a very close intersection between mobility and travel. Car rental, short-term car rental has typically been a pretty integral part of travel, as has been the case for flights, hotels. So this has typically been the sort of stronghold of the likes of Booking.com and Expedia, what some might call OTAs, online travel agencies. I think this is interesting because Uber is now stepping, from, I guess, moving from just a a more conventional mobility use case that we've come to know them for into other vectors of travel, like car rental. And obviously Uber has, a lot of blue sky, or had a lot of blue sky pursuits that were pretty public. There were interesting ideas like, Uber Elevate and Uber Air. They had the micro mobility plays. So I think it's interesting to see Uber continue to build out different methods of transport for its base of customers. And they obviously have a myriad of options to travel from A to B.
Okay, so a couple of times in what you said now, there's some terminology that comes easy for you because you're in the fraternity and obviously you've built a business inside of this space, but you're going to have to debunk some of those taglines for us. So we talk about mobility platforms. Perhaps let's start with, just for people that are new to this environment, new to the Simple Capital community and haven't had the exposure to FlexClub as yet, what does FlexClub do here?
Yeah, so we run a vehicle subscription marketplace that allows our members, what we call our members, to subscribe for a vehicle through an all-inclusive monthly fee. It's completely flexible, and I guess the clue is in the name of our brand. But you can cancel the subscription at any time, you can swap the vehicle at any time, or you could even choose to buy the vehicle at any time. And this we felt was the best of both worlds, considering the evolution that mobility was going through. A lot more consumers are starting to challenge sort of the old guard and the way we used to think about cars in particular, where now they're totally open to the idea of having a car on a flexible basis, go onto our marketplace, order the car or shop for the car that you're looking for. In under a week, we deliver that car to your door and enjoy it for as long as you please. I think that's really the magic of what we're trying to bring to the mobility ecosystem as FlexClub. There's certainly a lot more we can do in that space, even beyond cars.
So just subscription for a vehicle. Like I think people my age that young, very young in other words, will think of subscription as something associated with a magazine. When you say you subscribe for your car, like practically, what does that mean?
So practically, it's a monthly fee that you're paying for your car that includes everything related to your car except the fuel. So when you subscribe for a car, hypothetically, let's just say you take an entry-level vehicle. For those guests that are maybe not from markets like South Africa or Mexico, for about $250, which is the entry-level vehicles that we have. Per month, you could get a vehicle, order a vehicle, no need to get additional insurance, no need to get additional maintenance plans or maintenance coverage. Once you've ordered the vehicle, we deliver it to your home in under a week. And as soon as you decide that $250 is too much for you, or maybe it's too little, you decide you want to spoil yourself, or you've just got a massive promo, you can then step it up to $400 and get a nicer car without having to really think through that process of what do I do with this car? Do I have to negotiate with a dealer, trade it in, figure out how much I owe the bank? None of that complexity exists in the subscription world. So some might compare it to rental or termed rental, but it's different in the sense that it doesn't have a lot of the features that traditional car rental carries. Like, for example, the idea of standing behind a check-in counter, needing to put a massive credit card hold on your card, and even having the ability to choose a specific vehicle versus a group of vehicles.
Okay, now the obvious question is, does it work? And here's the little teaser slide to suggest, it's going in a certain direction. How's it been?
Yeah, look, I think we're incredibly pleased with the traction we've seen in this year. Obviously, what you see here is really the size of our marketplace, what we think of as our community of members. Our community of members over the last 3 months has almost doubled. And this is also driven by the fact that we just launched a consumer product very recently. So obviously, most people appreciate that COVID and the pandemic had a massive impact on mobility more broadly, not just in our world, but even as it relates to Uber and different sort of vectors of mobility. So to see recovery come through and to see recovery come through this strong is incredibly exciting. I think it just validates that consumers are now more open to the idea of thinking differently about how they access and engage with cars. And obviously that's one of the topics, or the overarching topic we're discussing is how people consume goods, and how is technology really changing that. And I think we're excited to really be presenting an exciting alternative to the old way of buying a car, which was I do a bunch of research, decide which make or model is my brand, maybe walk into the dealer, have a kick about the tires, chat to the dealer, then figure out I want to actually now finance it, negotiate with banks to figure out how I get the best financing rate. Then I have to negotiate with the insurer. And then the dealer is going to try to sell me some maintenance plan and all manner of insurance, third-party insurance products. And then I drive it off the lot and I realize this is not the one. I made a mistake. There is no U-turn. The minute you drive off the lot, depreciation, that's basically you carry the hot potato. I like to say it's a game of hot potato. You carry all the risks when it doesn't actually have to be that way if you start to introduce technology in designing a new experience. And that's really what we're seeing here, is that more consumers are excited about that experience as an alternative.
Yeah, I suppose my take onto that would be twofold. First, I bought a new car 3 months before lockdown started in South Africa, and it's been standing in the garage aggregating like a 50th of the mileage that would ordinarily do, while the clock is still ticking on its depreciation. So every time I walk down to the garage, I look at this set of capital slowly losing value over time, and there is therefore then a need for me to look at this differently. But what alternatives exist? So certainly going after a nice segment of the market there, that's in the mobility space. But are we perhaps then talking about this not only as a concept of how you buy a car, but perhaps much broader application? What do you think?
Yeah, absolutely. I think this is one of the major trends that we see, permeating across multiple industries. I mean, I think the principle of the trend was, or it sort of evolved in the software space. So some on the call might appreciate, the SaaS reference, software as a service. Not so long ago, in fact, I recall, a time when I thought about how I get access to a spreadsheet, it was I buy this box that has a bunch of CDs in it, and I install Microsoft Office, and I, at least have to pay this big lump sum to acquire that software. And today, I mean, maybe there's some that don't even appreciate that world and only know Microsoft 365, where it's just a monthly fee with access to all that Microsoft offers. And that evolution we're seeing happening in a number of different industries, and that's why you're seeing, I guess, this reference to different experiences, products, or consumption, basically consumption elements as a service. And that's something that we think is going to permeate across different aspects of economies. We obviously saw this in content. Again, same analogy: DVDs, CDs. How many people do you actually know that still have a DVD collection or CD collection? Most people will tell you that they've got their playlist of Spotify, or they've got their favorite movies or shows on Netflix. Why couldn't that extend to a number of the other things that we consume day to day?
What's driving it? Why is this happening? Other than COVID, that's sort of fast-tracked investment in technology. I see some of the consulting firms are estimating 5 to 8 year leapfrogging through the pandemic. But it feels to me like there's another macro here as well.
Oh, 100%. So there are a few different tailwinds that I get really excited about. But one of the big ones, I like to zoom out and think about consumption at a macro level, like you pointed out. What actually drives consumption in an economy? I'm no economist, by the way, so if there are economists on this call, I hope I don't offend your profession. But my layman's understanding of it is that, consumption is actually what drives GDP growth. And if you unpack that further, debt is a major driver of GDP growth or consumption overall. And I think this is an interesting graph because it points to a major economy, obviously the largest economy that we're all familiar with in the United States. It's a $20 to $21 trillion economy with household debt sitting somewhere around $14 trillion. So about 70% of consumption is actually been driven by debt. But that's not necessarily a bad thing. That's actually how most economies around the world, drive consumption growth. But then you unpack that even further. It's like, what are we actually spending on? What are we consuming as humans? For the vast majority of us, we're actually spending a lot of our dollar that we can access on where we live. So mortgages drive consumption and household debt predominantly. But then you go below that, so in an economy like the US, $10 trillion is driven by mortgages of the $14 trillion of debt. So roughly 70% of that debt is mortgages. Then you have about 10% a piece on education and cars, auto loans. So 90% of debt in the American economy is driven by those three things that we consume. And I guess, the thing that we have to kind of maybe take a step back and ask ourselves is this the only way for us to drive growth in our economies? Do we all have to take debt to consume and drive growth in our economies? And I think this is where it becomes exciting, is that we can start to apply technology to maybe provide access to these goods, to these consumption experiences, without having to burden households or consumers with the debt. And obviously, I think an interesting piece about this over the last maybe 10 years, there's been a massive sort of focus and investment in fintech, because fintech was a big part of fintech was premised on the idea that there are gates that surround debt. People decide who gets access to debt, and by extension, who gets access to these consumption experiences, who can buy a home, who can buy a car, who can go to university. And a lot of what fintech was bringing to the table was saying, guys, let's think differently about how we define who can get in. And I think that's all good and well, and certainly applies to a massive segment of population, and there's still a lot more work that can be done there, especially in emerging markets. But what if we thought differently about consumption overall, and figure out that if we thought about it as a service, we might increase access more broadly. So go back to the idea of homes. What if you had homes as a service? What if you had education as a service? I pay a monthly fee to access all the education that I need. Or obviously, in our case, and almost selfishly, what if you had cars or vehicles as a service, where we're not using the same underwriting lens that lenders or financial service providers might use when they think about who gets access to these consumption experiences?
I mean, this is a whole new ball game, right? You're now tickling some of the underlying fundamentals in some cultures, and in some upbringing frameworks. I need to own my house because it's my asset, and how dare I pay someone else's bond? And you're tickling that when you're talking about household debt and it being 70% of all debt, and delivering that service or asset through a totally different model. I mean, if I go back 2 slides, just real quick, education, I'm sure Theron will comment on this later from a specific US perspective, but like proper university costs in the US are astronomical. And what you're talking about, if I'm hearing you right, is to say it's digitized, therefore we can democratize it. And that might help with the demonetization such that the unit cost starts to shrink and the consumption pattern changes to an affordability rather than a debt pattern.
100%. Exactly. I think you hit the nail on the head there. Really, I think that's the opportunity, ahead of us, is to rethink, that framework for consumption. Obviously, I think a lot of this is driven by our social conditioning. We have been, myself included, for a long time, I kind of perceived car ownership as a rite of passage. I have to own a car. That's just something you have to do. And if you start to unpack that social conditioning, even as a consumer, why do you want to own these things so badly? Is it because you're fearful that you won't have control? Is there some sort of sentimental reason? Or is there genuinely an economic reason why you want to own? And I think if you look at a market like South Africa, the way the debt is structured, particularly in the auto loan space or in the auto space, there's a lot of smoke and mirrors there that the average consumer just doesn't understand. So, I won't bore the audience with the detail here, but there's something referred to as a balloon payment in the South African financing world. That, I hate to break it to everyone, or to pop the balloon, that is not financing. That is leasing, where the risk is passed on to the end user. Yeah, Theron could obviously point to the idea that in the US, leasing is not a construct that allows for the risk to be passed on to the end user. A leasing provider carries a risk. If you don't want the car anymore, they just take it back. And I think that there are a few things that we need to redesign and fix to increase access to these services. And that's obviously where we focus our time, is building this marketplace to increase access to vehicles as a service. We have partnered with major brands like Avis and Europcar, major automotive groups, and also raised some capital from leading investors in the mobility and marketplace ecosystem.
Okay, and so that was actually the previous slide there, because you're now trying to traverse quite deep cultural engravings. And I was going to ask, well, how's it going? But you can see from the headlines that it's going pretty well. You showed us the subscription numbers going up, but it looks like the capital markets are similarly responding positively. And you spoke of brands and partnerships. There you can see Europcar and Avis. What's that QR code? I know what it is, but tell the people that don't know.
So for those that don't know, you can scan the QR code. It'll take you directly to our marketplace. So you can do some window shopping. If you feel really bold, you can go ahead and order a car and test whether the car arrives at your gate next week. Obviously, assuming that you're in South Africa. So yeah, I encourage you all to just check out our marketplace. And again, like I said up front, even if you're not looking to buy, even if you maybe want to be a part of our team, work closely with us, we're totally open to engage. So please do reach out there as well.
Okay, and then my last question before we go to the panel, and I'm going to encourage people, I'll put the Q&A QR code up again for you to engage us directly or through a digital channel. But like a VW Polo 1.4 for 5,184 Rand a month, how does that compare when I buy the thing over the normal credit that we're trying to disrupt here?
Yeah, so it compares incredibly well. In some cases, it may be cheaper than your total cost of ownership when you take the traditional financing path. That's another thing, is that most people don't actually factor in total cost of ownership. Yeah. They see the TV ad, and the TV ad might read, from 1,999 per month. But obviously, if you look at the fine print of the TV ad, it refers to the fact that it's financed over 72 months, 35% balloon, the same construct I described up front, and doesn't factor in the fact that you still have to pick up the phone, call the insurer, and figure out who's going to protect you if someone steals the car, if you happen to be in an accident. Doesn't factor in the maintenance that needs to be done on that car over the period of that financing. So total cost of ownership compares really well to the idea of subscribing without having the long-term commitment or the burden of debt rest upon you.
All right, Tinashe, I'm hoping all of the very best in success and growth for you in the subscriber base with that compelling value proposition. And I'm sure that as a startup or early stage company, you've gone through some pains, and I'm going to switch to Alon here. And ladies and gents, while I do that and give him time to unmute, here I've put the QR code again. Please scan it with your mobile device. I know the Apples have got this built into the camera AI, but if you have an Android that I think is more than 6 months old, at this stage of the game, you'll have to do a QR scanner to get this done, which you can find in the Play Store. Most of them will work and pick this up. So please pick up on the QR code and feel free then, as it takes you directly into the Slido platform. You'll see that there's a popular questions section. Just basically type in your question and hit ask, and then we'll pick up on it on this side and try to put that to the panel who can't see it. So I'll read it live. But Alon, Tinashe is going through a stage now as an early stage company where he's got to fight some norms that have been there before he and his company came around. And I'm sure that Uber in its early stages found something similar. You were first employee in Africa. Perhaps just illuminate for us a little bit about the consumer learning about your product and how does one fast track that? And secondly, if I can ask you a double barrel question, when Uber came to Africa, talk to us about the regulation. And my understanding is that definitions in local transport regulation did not account. It had essentially definitions for taxis and definitions for car rental or public transport, but not Uber. And what is the lag between regulation catching up, and how do you deal with it?
Great. So let me start with the regulatory question. What's the lag? That's a good question. So we started regulatory discussions back in 2014 with regulators about the National Land Transport Act. That bill was finally passed in 2020, and it still hasn't really been fully gazetted. So I guess the lag is very long. And as a startup, I guess you may be faced with this conundrum, right? What do you do? Like, do you wait for regulation to change, or do you work within the realms of existing regulation? And that was a challenge that we were faced with at Uber. And I remember early meetings with regulators where, one, they wouldn't really take us seriously. We had to bang down doors to get in the door. And when we were there, they were really just ticking a box saying that they'd met with us versus really trying to ensure that we changed regulation. So what we had to do was we had to work within the realms of existing regulation, which is exactly what we did. And whilst there was no operating license for a ride-hailing driver, there were operating licenses for meter taxi drivers. And we worked with regulators eventually to get them to agree to ensure that ride-hailing drivers could use those operating licenses. So whilst it wasn't perfect, it was a doable or a workable solution. So I think the message there is, how can you work within the realms of existing regulation to find a way for the new business model to fit in whilst you work towards a new form of regulation? Because if you're going to wait for new regulation to be passed, you're probably never going to build a business. That did lead to some controversy for us. I think if you've watched the news, you've probably heard of that. But stand by those decisions. We never did anything that would compromise on safety. Rides were always insured and drivers were vetted. Uber obviously introduced trackability, accountability, all those sorts of things, which did not exist previously in the industry. So if anything, we were making the industry safer than it was before, plus, importantly, creating economic opportunities on the other side. When it comes to your first question on what should startups think about and how should they go about creating consumer awareness, you may need to invest to do so. Again, if I look to or think back to the early days with Uber, it was very hard to convince people to take a ride. I think to the point that Tinashe made, people would often compare the cost of driving, which in their minds was zero, to the cost of an Uber trip. So people wouldn't really equate, okay, well, I'm driving, there's a fixed cost of the vehicle, there's running costs, there's depreciation, etc. So there's actually a cost to a trip that you take in your own car, but they wouldn't make that equation in their mind. So we would have to really change people's behavior. In the context of the African cities where we operated, and we operated in over 16 cities, 7 different countries, using a taxi to move around wasn't commonplace, largely because before Uber, it was quite expensive. And again, I'm generalizing, but on the whole, quality was inconsistent and safety was sometimes a concern. Plus, it was pretty inconvenient. If you weren't like leaving a club in the heart of the CBD and you were in more of a suburban area, I know where I used to live, it would take you up to an hour to get a taxi. So you had to change the way people thought about moving around because that alternative did not exist previously. So again, investing, we could control one side of our marketplace more easily, being the supply side of the marketplace. So when we initially launched, we had to convince existing metered taxi operators to partner with Uber. We could guarantee their earnings to a certain extent, provided they were accepting trips and completing trips. And what that did, it meant that if someone was opening up the Uber app, they weren't waiting 15, 20 minutes. They were hopefully waiting 5 minutes or less. And as people got to see that Uber was reliable, they would be more likely to use Uber in the future and more likely to tell their friends to use Uber. We obviously also invested on the rider side. Again, if it's something untested, if we can give you a free trip up front, you'll probably give it a shot. So we did that. We partnered with a variety of brands across the continent, which helped build our own credibility, and it helped those brands give value to their own customers. Plus, we did a lot like things which were out of the box at the time. Now, if I say something like ice cream on demand, it doesn't sound that exciting. But when we did it for the first time in 2014, Uber Eats didn't exist, right? So the fact that you could order ice cream from your phone was pretty cool. We did guide dogs, a lot of exciting partnerships with DJs and those types of things. So I guess that was a long answer. The short answer is you need to invest in your marketplace to drive growth. And that's, I guess, why you need funding. And that doesn't mean that you have an unsustainable business model. That means that sometimes you need to invest to drive that initial adoption.
Alon, I love that you said that. And I want to just quickly pick up on that before I switch to Theron and say, Simple Capital often gets confronted in its corporate arm, where we do venture capital management on behalf of large corporates that know that they need to get into future proofing, i.e., take account of some of the trends like we're discussing tonight. And when Uber is cited as an example, we often get, but Uber doesn't make money. You use the word invest probably 6 times in that conversation. And so it's illustrative of a cost incurred to be able to dominate market space. But just quickly, for everyone watching that hasn't gone through the 11K of Uber, does it make money?
Yeah, so I'll answer this very quickly. I think the first thing, if you look at Uber's expenses, the largest expenses on the income statement are going to be incentives that they use on the driver and the rider side of their marketplace. And this would apply to Uber Eats as well. And that's largely controllable. So if Uber chooses to invest less in incentives for riders and drivers, that drops straight through to the bottom line. Yes, that may mean that future growth is slower, but that's a controllable expense. And if they want to switch off the tap of spending, they can do so relatively quickly. I think that's quite a unique thing. Another thing which is publicly available, you would have heard the Uber CEO say this multiple times. The rides business is profitable across most of the markets where Uber operates. So that business, being the most mature business within the Uber portfolio, is a profitable business and still a growing business. Obviously, COVID hit that business very badly, and you kind of derailed some of the growth and the momentum. But despite that, again, if you refer to some of the CEO statements, the rides business does remain a profitable segment of Uber's income statement.
Okay, that helps debunk it for sure. Growth costs money, but doesn't mean your business model doesn't work. Interesting, though, that Uber might be faced with some of the disruptors like we have in the room today in the form of Tinashe. But before we delve into that, because I see, Tinashe, I've got a couple of questions forthcoming that talk to your business model. I want to switch to Theron just real quick and ask Fifi, very interesting name. Tell us a little bit about the business as well and what it does. It's specifically leading to this democratization theme, which we see is not just the tip of the iceberg, but a much more weighted trend in the world.
Yeah, and a couple points when it comes to regulatory in specific. And it's interesting because the thing that I was thinking about as this discussion was evolving was, and especially as a startup founder, you have to think, what can we do? Like, if we can't do that, what can we get away with? How can we augment legal, or how can we augment whatever? How do we talk with the regulators and say, you know, what can we get away with today to accomplish our goal in the future? Because as stated earlier, you know, if you wait, you'll just never get the company off the ground. The other, and one of the things that we're approaching right now, and how it kind of combines with that regulatory piece again, is in investing. And it's very a dark art to a lot, right? It's just something that you don't really know what happens. There's investors out there, and then there's the rest of us. That's also a model we're approaching with SaaS. And we're building one of the first SaaS platforms for investors, and it gives you, special access to deals and deal flow and a community and people transacting on deals. There's certain models we're looking at, for example, special purpose vehicles, so you can do investments in companies you might be out of your reach traditionally, but we have opened this up to a marketplace globally to investors all over the world, saying, hey, whatever your flavor is, if we want to invest in a Silicon Valley Bay Area company, there might be a pro rata position. There might be some available allocation that you could invest in, and we can help facilitate that. So it's really just creating transparency. It's very opaque. Giving an ability, you don't have to say, hey, I have, I'm a multimillionaire, and so therefore I invest. You should be, and that's really, if people ask me what's one of the things I kind of regret for myself, if there was a thing in my life trajectory and things like that, it would be I didn't start investing earlier, because I could have invested in my friends' companies. I could have been a part of some of these things that have really changed the world and made it a better place, and I didn't even know how to get started. I didn't know, what was step one, and how does any of this work, and what, it's all this legalese and lawyers, and I don't know what costs is what, and what I get in the end. So we want to bring a lot of transparency to that.
Ron, it's a difficult balance to strike, I'm sure. I mean, the SEC is renowned for being quite a strict, yet in aspiration, progressive regulator. But the Gini quotient, I don't know, for me, you have to be already rich to be able to invest in opportunities that have high yield. Kind of seems to me to exacerbate the problem that we have with dividing of the riches. But at the same time, sophistication of some of these financial scoundrels take advantage of users, and so there is a need for regulation. How do you democratize without negatively disrupting?
How I would extrapolate that question is education. a lot of it's around, is this, if you were to look at it like the public markets, and let's say it's, let's take index funds, for example. You're not just banking on one company or two companies, you're investing in a series of companies, and you use this as your model. So if I was to advise you on your investing strategy, I'd say, okay, what is the total that you want to invest over the next 5 to 10 years? And break that down to an annual. And then how many companies does that get you per year? And how much do you want to invest in each one of those companies? And then for that quotient, you're going to hit one hit every, let's say 10, every so many companies, that's going to repay the rest of them. So it needs to be part of an integrated theory that you start to live and say, hey, just like I'm doing some other service I pay for on a monthly basis or something like that, here's my model for investing. And I plan on doing this model, even if it's a small dollar amount, over the next 5 or 10 years. And that's how we afford it. That's how we accomplish it. And out of some of those, we're going to get an outsized return that will cover all those other failures along the way.
I understand. And then I suppose one of the questions which I know that fund managers, which you're not, are often confronted with is, so why am I paying fees if the underlying portfolio doesn't perform? And I would ask, I know I'm springing this on you, the fee structure for FIFI, does that take account in the same way as democratization of the opportunity in the fee structure, or is that different?
Yeah, to date, and I need to be, to date, we're charging for the setup. So we aren't charging a percentage on the amount. And there's a couple of reasons, and back to that regulatory conversation, and I'm not sure if this is global, but in North America, in the United States anyway, you have to have a broker-dealer license to be with the SEC, and so they don't audit you and all of this, and with FINRA, excuse me. And these are the regulatory people out there. So what we did was asked ourselves, well, what can we do? What we can do is help by creating a setup fee for these transactions. And with that setup fee, you get the special access. So you get, and also part of the SaaS model, you're getting a lot of more benefit than just being a part of one investment or one company. And so we can spread the rest of that cost out over your monthly SaaS, over that monthly SaaS model. So it's not, hey, you need to invest this much money today, or we invest at a percentage of whatever that dollar amount is. We can come in and say, hey, we'll set you up for a service fee to make sure everything runs correctly, make sure all the T's are crossed and the I's are dotted, et cetera. And then from that point on, as long as you're part of that SaaS product, as long as you stay engaged, you're going to continue to reap the benefits of that. So we can, and just like cars and buying and getting them when you want and stopping at any time, you kind of liberate the person to say, hey, I want to continue with this because I want to continue, not because I'm trapped in some, this is the fee that it costs. Here's our, we have an office in downtown Silicon Valley, and why am I paying those exorbitant prices for this if the fund isn't performing? And by the way, I'm not going to see that return for maybe 10 years, right?
Okay, so interesting that this is extending way beyond a business model that Tinashe has stumbled upon or engineered. This is much wider scope application, and I think these are wonderful examples of it popping up in everyday life. And I like that slide of everything as a service. I myself stumbled over an analogy which for the guests, I shared with for the audience, I shared it with the guests before, and then I asked them not to pillage it. So James, thanks for playing ball and not stealing it. But this talks to a broader concept of mind frame of abundance versus mind frame of scarcity. And the analogy that I was given, for me, summed it up great. So if you ask the average household, do you own a drill, like a power drill in which you make holes in the wall? A disproportionate amount of households will raise their hand for that, so like 90%. And then the question is, well, how long is the aggregate use time of a drill? And I don't know how you measure this, but the research suggests it's like 1 minute and 20 seconds. And so if you amortize the cost of the drill over the 1 minute and 20, it's a super expensive hole that you're drilling. And then the question is, well, why are you still buying a drill? And the answer is a mind frame of scarcity. There aren't other drills readily available on demand as and when I need them. But if they were, then potentially you might relook purchasing the drill and rather going to this use as a service concept. So to that end, we've got about 8 minutes left, and we promised we'd be punctual. So gents, can I switch to the open air questions and maybe just pick out a couple here? We'll see how we go for time. The first from Ali, that is directed at Tinashe. This is going to be about your business model. So we get to punt FlexClub again. How complicated and onerous is the sign-up process for your business?
Yeah, it's a great question. And actually, this is where we...
Well, sorry, while you're answering, also I can combine two for you. What is the average age of the vehicle the consumer would receive?
Yeah, so I mean, going back to the point around maximizing customer experience, we developed a customer experience that allows for all of that to be done online so that it's not onerous, where obviously the alternative is an otherwise onerous financing application, etc. So everything can be done online. We do what we call a verification. That verification includes identity verification, affordability verification, and credit verification, just to ensure that this subscription is actually the right one for you. And obviously, if it's not, we can obviously point you to one that's more appropriate. That's all done online to make it simple. And then on the age piece, all our vehicles are what some might term in the industry demo vehicles, because they're very low mileage, but they're newer vehicles. So we never have older vehicles. The other benefit that our members enjoy is that when a vehicle reaches a certain age and they don't want to buy the vehicle, we just show up with another vehicle and basically a newer vehicle and just take away the old one. So they're always in the latest model of subscription. And that's obviously a massive plus to ensure that it's always the highest quality.
And then perhaps a follow on from that, who's your target audience? I see that's come up on an upvote here. Who is FlexClub primary target audience?
Yeah, so our primary audience is basically a segment of customers that appreciate that their needs, as far as it relates to cars, is more transient. They don't need to be tied down to a car for 6 years or longer. They're not trying to buy a car that they can drive until the wheels fall off. So that tends to appeal to people that are a little more nomadic, the digital nomads. The rise of the remote work is obviously great for that. People that are on staycations want to be in a specific city for 6 months or less. We also have strong interest from those that maybe don't want to adopt traditional finance. So we have expats that are also members on our platform. And in future, obviously looking to kind of open this up to a wider spectrum of customers that appreciate the flexibility that we provide in subscriptions. But as it stands now, most of it tends to be younger, digitally savvy customer base that is looking for flexibility. That said, it's not all driven by that demographic, but looking to expand that as we grow.
Thanks, Tinashe. And then this back to Alon, because this question came in 16 minutes ago, and that's more or less the time when we spoke about the growth curve and strategy of Uber. I think this was aimed at you, but potentially I will use this as the closeout question, and I'll ask the other gents just to perhaps answer it as well from their own perspective. What would be your exit strategy is the question. That came up during our conversation with Uber. So perhaps you can shed some light on this hyper-growth, always investing company, and at some point there's exit. Is that IPO? Is it selling to a PE? Just talk us a little bit through some of that sentiment, and then I'll pose the same question to the other gents.
Sure. So just one thing before I get to that, I quickly looked, and there's a stat that was released from 2019 in terms of kilometers driven by Ubers in South Africa, and it would have been over 2,400 trips to and from the moon. So quite a number. Going to the question, I think that the key thing is, what is your path to sustainability? Obviously, it doesn't make sense to invest in perpetuity, but you may need to make investments in the short term to prove out your marketplace. If I take it back to that example with drivers and the investment that we made in the marketplace with drivers, we did so based on what we believed once they became efficient. And what I mean by efficient, once there was sufficient demand from the Uber app for driver partners, what would their sustainable earnings be? So we could invest in the short term to supplement their earnings whilst there was not enough demand in the marketplace. And as that organic demand increased, so our investment decreased. So I think the key thing, as long as you've got a way to move towards sustainable pricing, investment makes sense. If you're investing just to, I guess, race to the bottom, or because you've got an access to capital, without that path to sustainability, that's obviously not a sustainable business model. But investing in the short term, or even in the medium term, with that path to sustainability in mind, definitely does make sense, especially if you've got to prove out your business concept.
I'll switch to Theron and ask for an answer around the same theme.
I mean, and this is a problem that you see, especially in the Bay Area, where startups think they need to fundraise just because you need to fundraise. Where there's and then also how much you're raising, how much that affects you in your next financing round. And those are two things I think that are overlooked. And like, what is the purpose of us trying to get this capital? Like, why are we going after this capital? What is it to get us? And it is, that sustainability, so you can really seed yourself and put roots in the market. But also with that round of funding, what is the amount of revenue that you need to make to justify another round of funding? And the reason being, when you take money, especially from an institutional fund, they don't want to invest in you once, nor do they want you to stop taking investment, right? They want you to continue to go on to your Series B, your Series C, and continue, because that then returns their value and a big multiple, which is what they're looking for. So as long as you're comfortable getting into that game, and as long as you can make those numbers work, and you think about the forethought of like where we're going with this, then it totally makes sense. At the same token, I've just been hearing this more and more. Not every company is an investable company. And even if you're a hot startup, it doesn't maybe necessitate that you have to take capital, which is something that I think is happening more when you look at sustainability of this marketplace, what we're actually trying to accomplish and do. And there is a very strong fit for those companies that do need to take capital, keeping in mind, especially at the young age of like first or second round of funding, that what are the revenues going to have to be for you to justify that next round of funding? How are you lining up those next investors, even at that time that you take on that first round of funding, to continue to create this equitable, we're in the market, we have these revenues to sustain that fundraise, to make it make sense for future growth, to get us to an exit, an IPO, something like this.
I love that thinking, Theron, and I think we're going to have you back for a separate episode in which we focus perhaps on some of these nuances associated with fundraising, because more often than not, I've been making notes as you were talking, I've run into entities that believe that fundraising is the success and not the sustainability that Alon had alluded to. And it's a fine line, but it's such a fundamental difference in how the longevity of the organization plays out. So to the Simple Capital team, I think we need to ask, and Theron, if we can twist his arm to get him back, and perhaps share some insights to other aspiring entrepreneurs inside of this space. I won't ask you to commit to it in real time, Theron.
I'll commit to it. I'm happy to. This is what I love doing every single day. So happy to be a part of this.
Well, fantastic. We'll definitely put something together. And then, gents, I'm going to close out. Tinashe, there are a whole bunch of questions around some of the logistics, tie-ins, minimum amounts, and all of the like. In a quick one line, where can people go to find these logistics questions associated with your business model, which clearly has stimulated some interest in questions? I think your subscriber base is going to grow tonight. Where can people go to go check it out?
Absolutely. We definitely welcome more members. Please visit flexclub.co.za. And browse, all the available vehicles. We do have an FAQ section there that addresses most of the questions, like what are the minimum subscription periods, etc. So welcome all the members that will be joining as a result of this webinar.
Fantastic. Gentlemen, thank you very much for your time tonight and joining us. To our audience, this is the end of our first episode. I think we might change this three-part series to a four-part series. But our next event happens on May the 11th of this year. Make sure that you join our community in the meanwhile to get access to some of these wonderful opportunities that we garner. And then to our guests tonight, a very, very special thank you for joining us and sharing your insights. And we look forward to our future engagement with you and good luck in your entrepreneurial endeavors. That's Simple Capital for the evening. I hope your dinner is not cold. And wherever you are in the world, stay safe and live through prosperity. Thank you very much. Have a good night.